On today's podcast, we have a repeat guest, Peter Linneman. We had him on back in 2022. He's an esteemed figure in the real estate finance world and a professor at Wharton. And you can find him at Linneman Associates. He writes the Linneman Letters, which is a newsletter on all things real estate, economy, finances, especially Federal Reserve interest rates. It's one of the resources I personally use. He guides top real estate firms and other institutional investors, and he definitely is a respected voice in the world. But for those folks out there who's not familiar with what's going on in the industry, let's catch people up, right? Like maybe let's start a little bit prior to the pandemic, which is in the backwards of our minds these days. And like, how do we get to today?
I think your starting point is a good one, which is way too many people, including at the Fed and in government positions and so forth, view this as a typical recovery from a typical recession. And as you well know, and your listeners know, it's anything but. It wasn't a typical recession, and it's not a typical recovery because it wasn't a typical recession. And just as a rewind, before the pandemic and the shutdown began, and let's call it 4 years ago, the economy was nearing the end of a prolonged, not terribly strong recovery, but it had been a prolonged recovery. It had gone 8.5, 9 years, which is quite long. Recoveries generally 6 to 8 years. Because within a 6 to 8 year period, excesses build up. That is not mathematically, it's just the nature of an economy. 4 years ago, in this past April, we had 23% of the labor force collecting unemployment. We forget that. The price of oil wasn't $60 a barrel or $80 a barrel or 90. It was negative. You actually had to pay somebody to take a barrel of oil from you. That's not normal. We were not able to shop in malls. We were not able to go outside unless you were essential. And we had defined essential. You could shop in Walmart, but only on the grocery side, not on the goods side. Disney and Vegas is closed. It's like a apocalyptic movie, right? To have Vegas closed. And you think about a normal downturn, you might get 6 to 10% unemployment. We were having 23% collecting unemployment insurance. A normal downturn, Vegas and Orlando might be off 5% in terms of top line revenue. It was shut. We lost jobs left and right. We set record levels and so forth. It had one good effect, and that was it cleaned out all the excesses in the system. So if you were a marginal retailer, you got put out of business during that. You were gone already. And anything that was excessive was cleaned from the system. That means the reset was from a very low bottom, 23% of the labor force collecting unemployment insurance and negative oil prices, pretty bottomish, right? And the recovery was going to be long and pretty strong, but remember, below average still. We kept adding jobs, 5 million jobs, 3 million jobs, 2 million jobs. In some cases, in a matter of months, we were adding that number of jobs. It was less an indicator of the strength of the economy as how miserable it was. We are still below trend on GDP. Now, there's nothing magical about trend except trend is what the economy can do over a prolonged period of time, more or less. So real GDP is still 2% below. So when people talk about, are we going to have a recession? You heard a lot of people last year saying, oh, we're going to have a recession. No way. We're coming out of a very deep recovery. We've got 6 to 8 years of recovery by any normal standard. The Fed gets worried when we add 300,000 jobs a month. The Fed should be worried in normal times if month after month we added 300,000 jobs. When we add 300,000 jobs, it still is 3 million jobs below trend. So yes, we have more jobs than before the pandemic. Yes, we have higher GDP, but below trend. So all these abnormal numbers are recovery numbers. And the whole notion, by the way, of a soft landing is absurd, because when you think of a soft landing, you think about your overheated economy, you're above trend, and can you cool it and bring it down to trend without crashing? we're below trend. We're still trying to catch up. So I think that's a quick where we were, where we are.
What I point out here, guys like Peter, he's been around the block, and
That's a nice way of saying
and
we're
contrast
old,
to it,
70-year-old.
and like these bumps happen, right? Definitely learn my lessons, but I think guys like yourself, who've seen many ups and downs, and you take things with the grain of salt, and you start to really realize what are the big trends, such as like workforce housing. We're not going to go into the obvious reasons, things for what they are, as opposed to the new retail investor. And we're all there at one time, right? We get excited by the headlines. Why? Because the media is designed to scare the crap out of us to get our attention. Just on the nightly news, stay tuned at 6. Guys out on the loose. He might come be in your backyard, right? That's
Yeah.
just how media is put out there. And that's where they're always trying to do these fear-mongering tactics.
And the fact that we have 24/7 news makes it even crazier. The fact that we have hypercharged 24/7 with social media makes it crazier. I had an epiphany the other day about social media. I'm not a big social media user. And for years at Wharton, we have course evaluations that were anonymous. People did them. I wasn't in the room as they did them. And 5 was the best, 1 was the worst, right? And you get back that 90% said you were a 5 and 10% said you were a 1. And then what you do is read the comments. You were a student, right? If you wanted, and maybe 15% of the students wrote a comment. And you'd read the comments, and the comments would be, "You're the greatest professor in the history of the world. There's never been a professor as good as you. This class is like God's gift to the world." And then you come to the 4th one, and it would say, "You're the devil's seed." And you go, boy, was that a precursor of what happens on social media, right? Which is extremes, and the ones that comment are extremely extreme, even though they're a small percentage. And that feeds what you're talking about as well.
I will add, this is not a political podcast, but I just wanted to add in something. I'm not a huge fan of social media either. I was just in another business mastermind. We had a consultant speak to us, and the topic was around marketing and reaching clients, as we are a small business. But the social media is a very manipulative tool to marketers, and it polarizes people very greatly. No longer do you have conservative, hybrid, progressives, etc. It's either one or the other. And what's funny, when you start to hear confirming biases, you listen to podcasts that confirm your biases, that the world is going to end, or politically left or right, certain things, it confirms your bias. And I get it. I'm at fault for this myself. I like to hear people say the same thing I do because it makes me feel smart and it confirms my biases, but at least I'm aware of it and I call myself out on it. But social media essentially does this, especially in the TikTok era, where things are served up to you on a viral basis, and 50,000 other people like a certain thing, but it pushes people one way or the other.
And I try to stay unplugged from all that. I try to focus on data. I'm a big charts and graph person. If you ever read Linneman Letter, which is a quarterly publication, we just have tons of charts and graphs. I can't tell you every day in the newspaper. I do the Wall Street Journal, Financial Times, and the local newspaper. Every day there'll be a chart of something and they'll describe it. And the chart doesn't say that at all. It's amazing the disconnect because people just want to hear the line. I'll give you a good one that's happening right now. Inflation has come down dramatically. So you have to step back and go to the story we were talking about during the pandemic. Supply shut down for tons of things. Companies went out of business. Lines of production went out. People retired early. All those things. So there was a massive shutdown of supply. And there was a big drop in demand because you couldn't buy anything, right? And then you were allowed to buy stuff. And when you were allowed to buy stuff, it came back faster than the restaurant that went out of business, than the company that went out of business. So we had across the economy, demand exceeding supply. And when demand exceeds supply, prices go up. And that's on average called inflation. And then those high prices brought about high profits, and high profits bring about increased supply. Or they brought about high wages. And what did that do? It brought workers back. right? And remember, probably when we talked in early 22, there was this narrative, nobody's ever going to work at a hotel again, right? Nobody is ever going to work on a cruise ship again. That was pretty silly, right? And so people are back because the higher wages brought them back. Okay, so now as supply came back, you've seen inflation basically disappear. And I'll take that in two parts. I'll just focus on CPI inflation. There are other metrics. And it's running about 3.4% annual, 3.4%. There's about 80,000 items, goods and services, and they surveyed them. And about those 80,000 on average will be about 3.4% more expensive than a year earlier. However, if you take out one item, they call it shelter, you and I would call it housing. Suddenly the inflation rate is 1.5%, not 3.4%. One item. That tells you two things. One, it must be a big part of that index. And the answer is it's about 37%, more than a third. And the second is, boy, it must be rising a lot, right? That's the only way you could get that big disparity. There are 80,000 goods and services that are on average rising 1.5% a year, and one item that's rising 5.9%.
And I'll also add onto that, maybe you can agree or disagree on this, Peter, but we operate a lot of apartment buildings, so we're on the front lines for this. Rents, the way they take the data on that rent data, which I guess you're saying is about a third of the CPI, is that they see where the rents are going, but that's all in the rearview mirror. People sign 1-year leases.
It's worse. It's even, you're right, but it's even worse than you're saying. 1/3 of that 37%, so 12% of all CPI are rents, like you're talking about. Renters paying rent monthly, okay? And they lag that data intentionally by 6 to 7 months. By the way, if it says peanut butter was up in May, peanut butter was up in May. But if it says rents were up in May, they're actually talking about what happened in November and December of last year. Now, that's crazy, but it's true. You know that what's happened over the last, 6 months is rental increases have largely disappeared. On a good project, you're getting 2% a year increase? In a weak project, you're getting minus 2% increase right now. Probably on average, right now, your renewals across the country are around zero. So the fact is they're putting in numbers from 6 and 7 months ago. Second problem is even more fundamental. Owners, 24% of the index is the rent that homeowners pay. And how did it go up? Now listen to the words, the rents that homeowners pay. Homeowners pay. I own a home. I don't pay rent. It doesn't go up. Literally, it doesn't go up. When I bought my home, I bought the right to no rent increases, right? They are saying that rents are going up for homeowners at 5.8% a year. But in fact, it's zero because homeowners don't pay rent. Now, people will say, yes, but what about gutter spouts that I have to replace, or windows, or insurance for the home? They're in the 80,000 items. They're in those other items. They're already there. Every other item except homeowner rent, somebody is actually paying out of pocket. Homeowner rent is being paid by no one. And they've got it increasing by just under 6%. And it's a quarter of the index. And therefore, that's all fantasy. So inflation is largely gone. The Fed is horribly misguided. Now, people say to me two things. Inflation is, you've seen these articles. This is exactly what you were saying about the media. They try to scare the daylights out of us, right? Oh, the price of eggs, name something, is up. So we can't have inflation's over because the price of eggs is up 22%. There are 80,000 items. Half of them are going to be up more than average and half are going to be up less than average. And just pure statistics, some are going to be up a lot all the time. Guess which ones they focus on? They focus on the ones that are up a lot, but the average is way down, 1.5%, except for this housing, which is largely driven by these two things, this artificial lag and this artificial treatment of homeowners. Yes, prices are high. Prices are high compared to where they were 2.5, 3 years ago. All right. No doubt about that. I'm tall. I'm not growing. Okay. So a child is short, but they're growing. Inflation is growth. Price levels are height. So what we had happen is the price of an item went from 100. And lo and behold, 3 years later, because of the shortages and the demand recovery, it's now 120. That's a fact. And that's the 20% inflation that took place over 3 years, going from 100 to 120. What does 1.5% inflation mean? 1.5% inflation means it's going to be 1.5% higher than 120. It's not going to go back down to 100. It's not going to go back down to 100. It's going to go up 1.5% from 120. And people feel the high price, which is very real. What they forget is their wage is a price to somebody else. So what people are doing is quite understandable, saying, yes, inflation's 20% over the last 3 years, total, right? And my wage is only up 22% over the last 3 years. But I deserve the 22%. I don't deserve the higher prices. The only reason they got 20 of the 22 was inflation. So they're waiting for prices to go, quote, back down. But that's not how it works. They're not going to go back down. We'd have to have a 25% deflation to get price down. And so that's not going to happen. And that's why prices today aren't where they were in 1951. We have low inflation, but high prices. I'm big, but I'm not growing.
And that's actually like the deflationary environment is something the Fed fears way more than this inflationary or even moderate extreme inflation.
Yep. And I think what you're going to see are those rental decreasing rates of growth, somewhere between -2%, +2% on rents. That's going to start showing up over the next few months because of the lag. And that's 12% of the index. The 25% that's homeowner rent, which is a fiction, it's a pure intellectual fiction. No one pays it. They basically try to figure out what you could rent your home for. I don't even know why that's an interesting intellectual exercise. And then I find out that maybe I could rent my home for more, but I'm not renting it. By the way, as opposed to your apartments, people are actually paying those rents, right? You're not paying this fictitious rent on your home. The whole thing is a bit bizarre. By the way, I don't blame it on the indexes, though. The Fed's behavior is not because the indexes are flawed. The indexes are what they are. A hammer is what it is. It's a hammer. If you use a hammer to put in a screw, is it your fault or the hammer's fault that it doesn't work so well? And I would say it's your fault, not the hammer's fault. The hammer was designed to do something very different. It is the Fed that's at fault for not understanding the difference between a hammer and a screwdriver, the difference between a nail and a screw. And they're treating it like everything is a nail and they're bashing away. And they're doing harm. They're doing harm to the economy.
And just for a little bit of review, so you don't leave anybody behind. So the inflation skyrocketed, and in a way, that's like a nail sticking up. The Fed is probably one of the most powerful people in the country and possibly the world. And their job is to keep inflation essentially at a neutral standpoint, but maybe +2 or 3% per year. But they go around banging the nails with their hammer, as Peter says, and that means increasing the Fed rate, interest rates. What that does is essentially it really hurts the housing and the financial sector at first the most. And in a way, it's trying to treat cancer and just trying to do a whole bunch of chemotherapy, and you're killing off some of the good cells too in there.
Yeah, and in this particular, it's even extreme of what you're saying. Because remember, this isn't even a normal cycle. This didn't come in the normal way. This came from the most bizarre economic, social episode in my 73 years of life, right? And that's the shutdown and the pandemic and all that. So to treat it like it's just another nail that needs to be hammered, first of all, that was wrong. It wasn't just another nail. It was a very extraordinary situation. You add to it, and you're so on target, you add to it the fact that it's a very imperfect tool they have anyway. So I imagine most of your listeners had to sit through a macroeconomics class. And in that macroeconomics class, you were dutifully told that what the Fed will do is they'll raise interest rates, and that will make people consume less, invest less. That will drive down GDP and get rid of inflation. That's the short version, right? That's an absurd argument when you think about it. So let's take it in pieces. And it was embedded in what you said. The Fed raises rates. They bang away with their hammer, right? Do you think that slowed government spending at all? State, local, or federal spending? All those governments that had to rehire teachers, all those governments that had to rehire firemen, all those governments that had to rehire policemen, all those governments who had to replace workers who retired early and didn't have any effect on the government, had none. State, local, and federal government is 35% of the economy. So 35% just you don't even touch. No, and I'm not even saying you should touch, right? There were fundamental things. Then let's go to healthcare. Were I to have a heart attack right now, and one of my people come in, I'm not going to say, no, don't take me to the hospital until Powell cuts the interest rate, right? Or if somebody is about to give birth right now, they're not going to say, no, I'm going to hold it in until Powell cuts the interest rates. So healthcare, medical, taking your prescriptions and such, totally immune to whatever the Fed does. That's 18% of the economy. So just state and local, federal government plus healthcare, you're at 53% of the economy immune. Education. Nobody is saying, no, I'm not going to send my kid to school today because the interest rate is high. There's no one. And when you do that, you come down exactly where you said, the financial sector, real estate development, people who rely on lines of credit secured by inventory and receivable, people who borrow to buy cars, some people who buy homes. Yeah, they're affected. Maybe that's 20% of the economy. So they're banging away at 20% of the economy that doesn't even need to be banged on because we're below trend, and 80% is completely immune. It's a very imperfect tool they have. And that's why we're still growing, even with high interest rates, is because we still are trying to catch up, pent-up demand. People forestalled cataract surgery, just put a face on it, right? And now they're coming in to get it more than normal. So we've got this pent-up demand driving the economy, plus normal growth, and then the Fed banging around on 20% of the economy, trying to slow it enough to slow the whole economy. It's not going to happen. And especially given how early we are in the recovery, it's not going to happen. It's definitely distortionary, and it hurts particular people. When I say people, entities, people, businesses, and so forth. It's completely misguided. I've been wrong now for 10 months because any rational thing would have been cut the interest rates down to about 3.5% now, maybe even 3% now. Why? Simply because inflation, absent mismeasured housing, is 1.5%. So I don't know why we would have these super high rates. Having said that, they keep them up.
I'll tell you why, Peter, because like the Fed goes after the score for them is getting that damn CPI to whatever that magic number they're looking for. Until they do that, based on their own messed up statistics, they can't proclaim a victory to the general public and pat themselves on the back.
You're 100% right. What they should do, you know how they do CPI without petroleum and oil and food, right? They also have an index that's very easy to get without shelter, what you and I would call housing, right? What they should start doing, quite honestly, is releasing CPI absent shelter, energy, and food. And they could then declare victory. Trust me, that would allow them to declare the victory. Because I think you're right, they're going to hammer away until they can declare victory. And by the way, this 2% inflation number, it's a made up number, right? There's no theory that says that's the right number.
Yeah. So I'm just saying what I think the big narrative out there for most retail investors is they're like, I've heard that the interest rates have hit their peak. They said they were going to reverse them by this point, but maybe it's in the next half a year. I'm just going to wait till that confirmation happens, right? But I guess like overall, what are your expectations for the Fed over the next 6 months, 1 year?
So great question.